So that might look like you right now because we're about to go into a more elaborate example. And so we're going to go through first cash transactions, and then we're going to look at adjusting entries, and then go back in and record some other entries, and then we're going to then carry it all the way through to trial balance, and then income statement, balance sheet, and statement of stockholders' equity. So these are the transactions, and these are in the book in Mod 3. So if you want to read the book, and it elaborates, of course, on the entire set of exercises we're about to do. So I created a template, and I elaborated some things just to make it all work nicely. So I'm going to go back to the Excel template. So here we see a more elaborate version of the template. I gave you a simple version just to show you the concept before I threw in the details of this particular exercise. What I've done differently from the Excel template you saw previously is I put columns here for every single asset. And that will make it easier for me to show you how we do posting. Same thing with liabilities. I put in all the liabilities and the remaining accounts. All right, so as we mentioned before, we have the blue representing the balance sheet. We have the green representing the income statement. The first thing we do is we input this row, which is the beginning balances, and there's no revenue and expenses when we start a year, so it's only balance sheet. The first transaction we see here is issue stock for $41.03 in cash. So we got cash, so guess what? Plus goes up, plus $41.03. And what did we do? We issued stock of $41.03. All right, so we're good there. Number two, transaction two, we purchased $140,327 of inventory on credit. Do we see? So we bought it on credit, which means our inventory goes up by $140,327, but our cash does not go down $140,327. Our payables go up $140,327. All right, let's pause for a moment. In the first transaction, the left side of assets equals the equities, so we're in balance. So this is like an equal sign, right? And then next we have 140 inventory, and we owe somebody for that, so that's also equal. Right? So let's do next one. We sold goods for $225,224, that's the revenues, which have a cost of $140,089. So as we did previously, when we sell a product, it's broken into two transactions, the revenue piece and the cost of goods sold piece. And so this is on credit, I believe. Yes, on credit right here. So that means somebody owes us money. Our customers took the products and they said, I'll pay you, right? But didn't pay us yet. So it's 225,224. Accounts receivable goes up 225,224. All right. Next, our revenues went up by the same amount. So on the income statement, 225,224 as revenues. And the little magic of the if command did its lifting. This made net income go up, which makes retained earnings go up. All right. Next part is there was a cost. We got rid of some inventory. How much did we get rid of? Minus 140,089. And on the cost of goods sold here, minus 140,089. Again, the little if command does the little magic. We're good to go. Transaction 4, we collected. So our customers were true to the word. They paid us back. So we're going to reduce what they owe us, minus 225,834. And we're going to get cash, plus 225,835. And then we're going to have accounts payable that we pay. So we owed money here. We had beginning balance of 121, and we had 140 that we owed more. And here we paid off some bills, minus 135,033. And so what did we pay it with? Cash. So that goes minus 135,033. So we're still in balance and still moving. Next, we have operating expenses and taxes of 4,100 minus 4,411, and that's for operating expenses and taxes. I'll just put it here, OpEx and tax. Now, normally we would not mix these. We would separately do the operating expense from the taxes. But here we'll just go with what they gave us, minus 4,411. Okay. Next is transaction 6, or 7 rather. Here we bought PP&E, property, plant, and equipment, for 11,247. So negative 11,247. And what did we get for it? We got PP&E of 11,247. We bought a truck or tables or whatever. Next, we bought marketable securities, so our cash goes down, minus 43,151, and our marketable securities goes up, 43,151, so that's in balance. It issued short-term debt. So how much did we get? 2191. That's a plus to cash, and to debt, short-term, is we owe more money, 2191. Next, we issued more debt, in this case long-term debt of 26,976. 26,976. And what is that? It increases our obligations of 26,976. Number 11 is we paid 514 in interest expense. So negative 514, cash goes down, and expenses on the income statement. So interest expense is minus 514. Next, we have dividends. So that is negative 11,627. And here we have, oh, here it is. I already put it in, that we have expenses which reduce retained earnings of negative 11,627. Next, we're on transaction 13. Transaction 13 is received 9,533 cash from customers for products and services to be delivered later. This sounds like unearned revenue, right? Deferred revenue. So let's record that. So it's 9,533. That's how much we got. And our deferred revenue goes up by transaction 14 is we received $17.99 in cash for dividends that we had on marketable securities. So 1799, cash goes up, and we'll just put it was interest and dividends. So interest and divs income, and that was 1799 as a positive number. So that was 14. Number 15 is we paid 19,121 cash for income tax. Cash goes down, negative 19,121, and the expense is income tax. Income tax expense, and it is negative 191. Number 16 were miscellaneous transactions, which I just posted here. They were given to us, and they're more detailed than necessary for this point of our learning.